Okay, in class, we discussed the double declining balance in a theoretical sense in order to understand the concept of why and how it affects the income statement and how it's moving what is initially a balance sheet item over to the income statement. But we didn't actually go into the mechanics, so I pulled off of one of the most authoritative sources in the world, Wikipedia. And notwithstanding its fact that it's not peer reviewed, it's a pretty good illustration, and the information is right on the money. So this is just to get so you'll know how to approach these problems when you see them in the homework assignment. This is double declining balance, and you can read through this and get a better idea. But for the record, basically what you do is the following: you figure out the estimated useful life of your depreciable asset in terms of number of years. And let's say we'll do, in order to make it easier, we'll do the one of the example which is on the page before. I'll go back to that in a minute and let you read through that. The estimated useful life, let's say, is 5 years. So normally that would mean on a straight line basis you would depreciate 20% per year. That's 1/5 in percentage terms. That's normally what you would do. Double declining balance simply means you take that amount and double it. So every year you'll depreciate 40%, but 40% of the prior year's net balance. Prior year's net balance. What do we mean by that? Well, let's take a look at the example. Actually, this example isn't as good as the one I gave in class, but let's do this on the next page and see how we come up with the answers that are going to be here, the depreciation expense. Or actually, let's see if we have enough room here. First year, what we do is we take $1,000, which is the cost of the item, and that's the original cost, with no deduction for the salvage value. Double declining balance doesn't take into account salvage value, at least in its depreciable base. So this is the depreciable base without reducing salvage value. We take salvage value into account by not depreciating it below salvage value, which we'll see, but that's how we do it. So we depreciate 40% of this in year one on the 40%, the double declining amount, and that'll give us a $400 depreciation in year one. So let's see if that's what happens. And in the example here, yippee-ki-yay, that's exactly what it is, depreciation expense. That, of course, the debits and credits cause that to become the accumulated depreciation at the end of the year. And this becomes the balance remaining net. The net, this is the net amount, net of the original cost minus the contra account of accumulated depreciation. So in year two, what we do is we take the net ended at year one, which is 600, and we multiply that at the same declining balance percentage, 40%, and here we'll get 240 if you do the math. So 240 will be the depreciation for year two, and that's where this number comes from in year two, depreciation expense year two. Then we're going to add this 240 to the accumulated depreciation here, come up with a new accumulated depreciation and a new net amount here. And so in year three, we continue the same thing. We apply 360 at 40%, and we get whatever that comes to in depreciation terms. And the chart here will show us that it is indeed 144. Cool. So what happens is we keep depreciating following this method until our depreciable base hits the salvage value amount, in this case $100, and then we stop. So we keep depreciating using the double declining balance percentage method of 40% until we come to the last year, which in this case would be the 5th year. And in the 5th year, we'll be left with some amount of depreciation that we can take, but it'll bring us, and whatever it is, it'll bring us down to the salvage value. If the amount in the 5th year of any depreciation would take us below the salvage value, we won't do anything. It becomes a plug. This last year is a plug to get to the salvage value amount, whatever we thought it would be at the time that we bought the equipment. That's how you do double declining balance method of depreciation. And as I said, I just wanted to go through that for purposes of further elucidation. I'm sure it's in your text, and now you can approach the homework assignments with confidence. All right, thank you.